Hello, everyone, and welcome to KJH Insights, our monthly podcast. I am Sarah Bull, partner and portfolio manager at KJ Harrison Investors. Thank you for joining us today on our podcast, where we provide you with an in-depth look at the biggest issues affecting the market and their impact on how we are building and protecting our clients' wealth. I have Joel Clark, CEO of KJ Harrison, joining me today. It's great to be together again, Joel. Good morning.
Good morning. How's it going?
Good. So, Joel, it's mid-April, and we have a lot of news to discuss and try to make sense of for our listeners. I mean, the start of Q2 began with the so-called Liberation Day, which many are actually now referring to as Demolition Day, which, of course, was when President Trump announced the global tariffs, and it was the start of the retaliatory actions by other countries, and really tariffs that the world hasn't seen for over 100 years. So we had our monthly client webinar yesterday where Peter Barlas, our CIO, and the investment team talked about the expected impact of these policy decisions. So I thought today, let's try to discuss and maybe create some key takeaways for our listeners around tariffs and the world right now. So do you want to begin?
Sure. So let me try to set the stage clearly. And I listened to the All In podcast with Scott Bessent, the Secretary of Treasury, who laid out the problems in the US and what they're trying to do and the timing around it, which was helpful. So let's start with that. So think of the US as a company that's going broke. They're negative cash flow, they're over levered, and they have to roll a significant amount of their debt this year. And so they can deal with it now, or they can kick the can down the road and sink the Titanic. So they're trying to address their problems currently. We might not like how they're going about it for sure, neither is the market, but they're trying to address their problems. So on the cash flow side, Doge comes in, they're trying to find some savings. The problem is these cuts are actually GDP to the economy, so it has a negative effect on revenue, even though they're cutting expenses. So they need to go out and plug that hole. So that's why they're going out and putting tariffs on, is they have to find revenue to plug the expense hole. And so Trump has put forth this tariff plan, as you say, Liberation or Demolition Day, and a bit of a shock and awe. He went after every country, and that was quite a surprise. The other objective Bessent is trying to achieve is to get bond yields down, because every percent is significant savings on that cash flow item. So how do you get bond yields down? You drive the economy into a recession that you control. So sure enough, that was happening. Got the 10-year from 4.6 or 7 to 3.9, but something very odd happened. Is bond yields reversed, and the Fed put was eliminated. I think Trump thought the Fed would come in and drop rates to help him so he could push forth with the tariffs. So all of a sudden the bond market reversed and we have a problem. And that is what led to the reversal of Trump's policies for the 90-day window. And so there's actually a lot going on, Sarah. It's more than just tariffs. We have a balance sheet problem in the US and governments around the world, and the bond market is starting to worry about it. So I just wanted to sort of set the stage as to, what's sort of really going on. And I think the reversal was important. Clearly, they want to take China on. It's better to keep your allies at bay and use all of them to take China on. But we'll see. It's volatile times, volatile markets. There's a lot of wood to chop. The economy is likely to go into some version of a recession, but here we are.
Yeah, so it sounds like what you're saying is there were some unintended consequences.
Exactly. And we talked about that last podcast is, the second and third derivative implications of these, whether it's a retaliation or, other countries form a bloc, or the bond market. I mean, what is the message that gold is sending right now at 32.50? So you're right, unintended consequences, and we hit the pain point for Trump and his team by way of the market and probably a bunch of incoming phone calls from CEOs.
So on that, are we starting to see tariffs impact corporate profits, and how is it impacting how corporate CEOs are making decisions here?
Yeah, and I find it useful to just take a simple business. So a simple business has to buy their inventory. Well, now they have to purchase their inventory at a 30% premium because of the tariffs. Well, where do they get that money? Where do they get the working capital? Well, they have to cut things to be able to afford the 30% incremental tariff. And so it just wreaks havoc on a business. All the while, demand is slowing down. So just extrapolate that one little simple business model to the whole US economy. And it's tough. I mean, businesses are slashing discretionary spending, they're cutting things immediately, they're looking at the fat. And at the same time, businesses need confidence and solid footings to make capital investments in the future. So they've reined that in. And so you're not getting the velocity of money going or moving in the economy. And so, things will sort of grind to a halt here. So my expectation is, we just finished Q1, is the reporting season's upon us. We're probably going to get some truth from many of these businesses as to where they sit in terms of an impact of the tariffs.
I think that's a really good point, right? Because the news or the data we've received so far hasn't really included the news since April 2nd.
No, and I mean, the market is discounting it, but we don't know if it's overly discounting, it's not discounting enough. And so now the process of unveiling where companies are, the messaging from CEOs in terms of the future, do they pare back their guidance for sure? Do they get more conservative? I mean, we've seen indications of Walmart pulling Q1 guidance, Q2 guidance. So it'll start. I think the odds of a recession, if we started the year at maybe 25%, are definitely in the 50% range for sure. So we're going to get a slowdown, and it's an engineered slowdown. And I just don't know if there's been too much damage already. I mean, the Trump tries to slough it off like everyone, good things are about to happen. Calls are coming in. We're negotiating, but he might have gone too far.
Yeah, I think that's such an important point, right? In terms of an engineered slowdown. Because if our listeners go back to, our December podcast, the economy was in fairly good shape at that point. And for sure, there was initial focus on tariffs instead of tax cuts as we started to head into the beginning of Q1. But a lot has changed since then.
Yeah, I mean, go back to our post-election podcasts when the market was ripping because of the pro-business policies of lower taxes and deregulation, M&A firing up, animal spirits, the pipelines of IPOs, whoop, like grind to a halt. Everything is reversed, and we're in a totally different spot right now. Now, they know this, so there's lots of theories why. Are they getting all the bad news out of the way? So the back half of the year and into the midterms, they start to hit them with all the positive things. That's what most people are thinking, but who knows? We'll see.
Yeah. And as we've talked about, and as Peter and the investment team has talked about, there could be some theory to the idea that they're trying to push through some of these things to blame Sleepy Joe.
Yeah, I mean, Sleepy Joe, and he's asleep. He's he's missing all the excitement, but I think he's gone too far. I think this is on him now. I don't think he can now blame Joe Biden or the prior administration. That these issues are something he brought on now, so he's dealing with the consequences.
Okay, so let's pick up on a couple other things that you talked about. Let's go to your comments on gold. You talked about gold kind of rising to above $3,200 an ounce or $3,000 an ounce. What is this telling us about fear and policy and positioning? Just dive a little bit deeper into that for us.
Could be three things. Debt levels, just general debt levels. The government data came out last night. It looks like tax receipts are below interest payments now in the US. That's so unsustainable. So that just means people's willingness to own US treasuries it's being seen as a bad investment. And so there's a flight out of US bonds that also hits the dollar. And so you have to go somewhere. So where do you go? Many other currencies are struggling economies too. And so gold is that safe haven. It's unencumbered. It has no leverage. No one can controls it. It's scarce. So that's one theory. The second one, which is a really interesting one, is one way to fix the debt problem in the US is not to address the debt side of the equation, it's the asset side. And the only asset you can revalue higher is gold. You can't revalue stocks higher, but you could out of nowhere just say, gold's now worth 7,000 or 10,000 and you improve your balance sheet. So there's multiple reasons, but foreigners, China, they're dumping treasuries. You saw the US dollar is just massively corrected here. Canada, it's gone from 145 this morning, it's 138 and a half. So there's a flight out of US dollars. So it has to go somewhere. And China does favor gold for sure.
I think that's a great answer. And then you also talked about the bond yield reversal, which I think was really interesting to watch this week. So, with yields reversing, what's the implication from that on equity valuations? Drill down on that for us.
Yeah, as we know, rates go higher, cost of capital is higher, valuations come down. So that's never good, always has implications. And when you're in an over-levered economy, it just gets exasperated. So, what's supposed to happen is when economies slow, bond yields slow, and central banks come in, lower rates to re-stimulate. But we've been stimulating for so long with a strong economy. The way I'm reading it is that there is no Fed put, and they're boxed. If Powell drops rates, I think the long end is going to shoot up and inflation's going to reaccelerate even further. So I don't think Trump can get any help from their central bank except for yield curve control, where they literally pin and fix yields right across the curve and basically lock into us living with high levels of inflation. And again, that's likely what gold is sniffing out early. There is no sort of solution, and that's, I think, is what gold is seeing.
Yeah, I think it's interesting, right? Both the gold and the yield reversal are both sort of speaking to the risk of recession.
Yeah. And can I hit you with a crazy stat? Do you know since 2000, gold has outperformed the S&P by 2 times, a rock in the ground over massive levels of technological innovation. It's mind-blowing.
Yeah, well, it's been a really chaotic 5 years for investors. They've had 3 big market corrections. So, that is a crazy stat, but also probably not surprising.
Yeah, exactly.
So, given everything we've just talked about, tariffs, risk of recession, this massive volatility we've seen in the market, talk about how the investment team is thinking about navigating all of this, protecting capital. What's the playbook?
Yeah, so you have to rely on your risk management principles. And we basically have two. Number one is asset allocation. We've been very conservatively allocated away from equities and more into credit. We've talked about that a lot. Why take equity risks when you can get equity returns and credit coupons? So we were already positioned conservatively. It was sort of a win-win. You had high levels of coupons while you're in a position to protect capital should things change. So that's your first line of defense. And then the second one is ensuring that you own, and we've stressed this, the best businesses in the world. The best businesses always get through tough times. In fact, they come out of them better. They go down less, they go up more. And so because we have an investment culture, we know our business is cold. We're not just buying an ETF or an index blind. We don't know what we own. We don't know the balance sheets of the management. We know every single company extremely well. And so when you go through tough times, you rely on that knowledge to get you through. So it's a twofold, multi-layered risk management approach that we rely on to get through times like this.
Yeah, and I think if we think back to what we've been saying since the beginning of the year, we're coming off the back of a strong 2024. And we talked a lot about investors having balanced and diversified portfolios to set them up for long-term success.
Exactly.
On the equity side, Peter talks a lot about, and you just touched on this, high quality dividend payers and dividend growers. Even though our clients have low exposure right now on to equities, talk about the equities that we do own.
I think potentially there's a pivot, Gretzky's line, skate to where the puck is going. If you believe you're in a reflationary environment, like there's no choice, the types of companies you own are going to start to change. Instead of the Nvidias, it's going to be the BHP Pilotons or the Rio Tintos and the Rails. I think global exposure, resource-based exposure, but all in keeping with the top companies in the world. And so, we're really starting to think through the implications of this shifting environment. And I was talking to Peter this morning about think of the implications to a company like Newmont or Agnico Eagle, who with rising gold prices and falling energy prices, I mean, the free cash flow that these gold companies are going to produce. Now they're more cyclical, so you have to adjust your exposure for that cyclicality and a bit more volatility. But you want companies that are debt free and producing free cash flow. You don't have to look any further to some of the Barricks or the Newmonts or the Agnicos now, and they've really underperformed for years. So we're starting to really think through where the future is going, and I'm not sure it's yesterday's stocks.
So, Joel, I feel like we could talk a lot longer. There is a lot to cover, but I also feel like we should sort of wrap things up here for this month. Is there anything else that we haven't touched on that might be on your mind or on the mind of the investment team that we want to share before we close up here?
No, I think, the only thing I'd say to listeners is there's going to be lots of headline news. A market's going to be whipping around. You don't trade them. You can't trade them. You can't outsmart them. Just either remove yourself from the market and wait till it all settles down, or just rely on owning great businesses and sort of ignore the noise and focus on the medium to long term. Try to re-extend your time horizons, because opportunities definitely will fall out of this environment. There's lots of stocks that are down 35, 40%, high quality businesses that, in 3 to 5 years will be a lot higher.
Yeah, I think all of those are great points, right? Remember that for many people, their investment time horizon is longer than they may feel it is right now in the moment. And really, we are focusing on asset mix and our investment process of buying best in breed companies. And as you just said, chaos ultimately creates great buying opportunities.
Exactly.
This is probably a good place to wrap up then, because I think our goal with this podcast is to cut through the noise and really focus on what matters and how the investment team is thinking about the market. So I think on that note, we will end here. Thank you very much to our listeners for joining in today. We'll be back next month with another issue of our KJH Insights podcast. Wishing everyone a happy spring. And as a reminder, if you have any questions about your portfolio, please reach out to us at any time. And we'll continue to provide you with commentaries and updates as the market narrative unfolds. Of course, all of those are available on our website at kjharrison.com. We look forward to speaking to you next month, and take care.
This podcast is produced solely for informational purposes and is not to be construed as an offer to sell or the solicitation of an offer to buy a security. The information herein is based on sources we believe to be reliable, but is not guaranteed by us and does not purport to be a complete statement or summary of the available data. Any opinions expressed herein are statements of our judgment on the recording date and are subject to change without notice. Any unauthorized use or disclosure is prohibited. Receipt and/or review of this presentation constitutes your agreement not to reproduce, display, modify, distribute, transmit, or disclose to others the content, opinions, conclusions, or information contained in this podcast.